Dear students, first of all, welcome to everyone in a very first live revision class of AFM for the session December 2025. Please, there's no homework, nothing, just focus on the class right now. Since it is a first class number one, so that is why it will not be very long at all. But from class 2 onwards, obviously, the duration of the class will increase. Okay. Day will remain once in a week, but that's for sure. Duration will increase. Okay. One more thing. All the students are supposed to follow the study planner strictly. Whoever does not have the study planner, just write the message in your relevant WhatsApp group to the admin that kindly share the study planner with me. Admin is going to straight away, they will be sharing the study planner with you. Normally they do give the study planner the day you join us, but by chance, if anyone does not have the study planner, you can always ask the admin. Okay, so you have to follow the study planner strictly. We will be revising AFM in this, and we'll follow the same sequence of the revision which we have in our recorded course. Okay. Another point, for theory, you people are supposed to use short notes. I strongly believe everyone is having the short notes of AFM. Again, whoever does not have that short notes, you can always again ask the admin. They will definitely share with you. Okay. So let's start. The name of the topic is cost of capital. AFM, and this session is December 25, first live revision class. Number one, the meaning of cost of capital is simply cost of financing. Another point which you need to know is the objective of cost of capital is investment appraisal. So these are the 2 points which you really need to know. The meaning, what do you mean by cost of capital? Simply cost of financing. The second is objective of cost of capital is investment appraisal. Now, next point. When your company is going to make investment, so obviously your company needs finance, and there are different sources of finance from where company is going to raise the finance, and each source of finance will have its own cost. You will not get finance from any source free of cost. Each source of finance is having its cost. So if your company raises the finance in the form of equity, if your company raises the finance in the form of equity, then your company will have to bear the cost, and which is cost of equity, and we show cost of equity by using KE. If your company raises the finance in the form of debt, loan, then the cost is KD1 minus T. Why KD1 minus T? Because interest payment results in tax saving. That is why KD1 minus T. Third and the last, which we have not seen in AFM in any of the past paper, but still you should know it for the sake of knowledge at least, that is preference shares. If your company raises the finance in the form of preference shares, then you have to bear the cost, and the name of that cost is simply KP, cost of preference shares. And obviously, when we'll be discussing KP, we will also discuss if the preference shares are redeemable, how do we calculate KP? If the preference shares are irredeemable, how do we calculate KP? Always remember one point, whenever preference shares are given, nothing is mentioned. We always technically assume given preference shares are irredeemable. In case of redeemable preference shares, examiner will have to mention that given preference shares are redeemable. Now let's just start from equity. If the company is raising finance in the form of equity, the cost is KE. Now, how to calculate KE? Cost of equity. KE we can calculate by using CAPM, capital asset pricing model. We can also calculate KE by using DVM, dividend valuation model. Another name is dividend growth model. Third and the last is we can calculate KE by using MM plus tax equation. And let me just tell you that in the next live revision class, we will be discussing this MM plus tax equation preposition 2, which has been changed and now it's not new. Of course, if you go 2 or 3 attempts back, there was a change in this equation. Obviously, we will be discussing a new equation, and that new equation is already in there in your syllabus. So we'll see what is the change in MM plus tax equation, and we'll be using this MM plus tax equation according to the new, I would say, format, and I'll use that during the live revision class. Just you need to know one thing. MM plus tax equation, whatever it is, but the main concept is MM plus tax equation is the alternative of CAPM. Right now, we don't know what is exactly MM plus tax equation preposition 2. Where do we need to use? I'm just giving you one concept. MM plus tax equation preposition 2 is the alternative of capital asset pricing model. It means where I cannot use CAPM, but I do need that CAPM, but I can't use it, then I'll go for MM plus tax equation. So you will see that. Don't worry at all. Let's see CAPM, capital asset pricing model. The formula is very simple. KE is equal to RF plus RM minus RF and equity beta. K is cost of equity. Another name for the K is minimum return required by shareholders. RF, risk-free rate of return. RM is average return on the stock exchange. Difference between RM minus RF. Student, what is the name for the difference between RM minus RF? Can I say it is equity risk premium? Equity risk premium. Another name is market risk premium. Another name is market risk premium. Another name is market risk premium. So you have to read the question nicely. Sometimes what happens, examiner gives you the equity risk premium, and which is the difference between RM minus RF. By mistake, student, they take it as RM, which is incorrect. Okay. Equity beta. Before any discussion on equity beta, you just need to know beta. Actually, beta is a measure of risk. Beta is a measure of risk. Okay. When we say risk, logically there are two types of risk. One is systematic risk. Another is unsystematic risk. Okay. And student, let me tell you, it's a live revision class. Okay. So I'll be a bit quick. It's not a regular class, it's a live revision class. So I'm putting the emphasis, it's a revision class. Whoever is attending this class, it means you have seen at least 3 to 4 lectures on cost of capital. There are around, I would say, 9 or 10 lectures on cost of capital, but at least you have seen 3 to 4 lectures on this topic. If you have not seen even a single lecture on this topic, then obviously this class will not be fruitful for you. So whenever you are sitting in the live revision class, make sure you have seen that relevant topic. And I think admin has already shared the name of the topic which we are discussing right now. Before the live revision class, at least from here onwards, at least 3 to 4 days before the live revision class, exact topic will be shared in your relevant WhatsApp group, that which topic we are going to revise. Then, of course, after a few more weeks, we will start the discussion of the recent past papers, and whatever question we'll be discussing, at least 3 to 4 days before the discussion of that question, it will be shared in your relevant WhatsApp groups so that you can also have the opportunity to attempt that question. Okay, now risk. So beta is only when we say beta is a measure of risk. When we say risk, there are two types of risk. One is systematic and another is unsystematic. Now listen carefully. Unsystematic risk is a diversifiable risk. Is a diversifiable risk. Unsystematic risk is the risk which you can diversify, you can spread, you can even reduce. Now listen carefully. CAPM, it has number of assumptions. One of them is CAPM assumes that CAPM capital asset pricing model assumes that investor is having a well diversified portfolio of investment, and due to that well diversified portfolio of investment, your unsystematic risk is zero. This is the assumption in capital asset pricing model. Of course, you can always raise a question on this assumption that, sir, it's not necessary that every investor is having a well diversified portfolio of investment. Your argument is well accepted, but the CAPM is developed in a way that CAPM assumes that investor is having a well diversified portfolio of investment. That is why unsystematic risk is zero. So we are actually left with systematic risk. Now, systematic risk is not a diversifiable risk, not a diversifiable risk. For example, if your government increases the interest rate, obviously your company cannot reduce it. So increase in interest rate is one of the examples of systematic risk. Another example could be increase in taxation rate. Obviously, you can't do anything. So systematic risk is not a diversifiable risk. This is the risk which your company will have to face. Okay. Now, when it comes to equity beta, number one, you should know one thing, that equity beta is a measure of systematic risk. Equity beta is a measure of systematic risk. Why equity beta is a measure of systematic risk? Why we are not saying unsystematic? Because in capital asset pricing model, we assume that investor is having a well diversified portfolio of investment. That is why unsystematic risk is zero. So it's systematic risk. So logically, equity beta is a measure of systematic risk, which actually indicates that how your investment will respond to the changes in a stock index. Assuming if a stock index increases by 2% and your investment increases by 4%, so we'll say your investment is more riskier than the market. Why? Because if you are generating more than the market, if you're generating more than the market, it means if in the future, whenever there will be a problem in the market, then you will bear the loss more than the market. So logically, equity beta is a measure of systematic risk, which indicates that how your investment actually will respond to the changes in a stock index. Now, for example, let's say we have risk-free rate 8%. We have got RM, let's say 15%. Case 1, equity beta is 0. Case 2, equity beta is 0.8. And third, equity beta is 1. Fourth, equity beta is 1.5. I want everyone to give me K in each situation. So obviously there will be 4 Ks. The main objective is not numerically to see what K comes. Actually, the main purpose is interpretation. First, I want everyone to calculate this. Then we'll be discussing the interpretation. I'm just giving you 2 minutes. Everyone is having 2 minutes to. Okay, that's great. Majority is having the same numbers. So main objective is interpretation. Let me tell you the interpretation. Number one, when equity beta is 0. Equity beta is 0 means you have made the investment where your investment is not facing any risk. Your investment is not facing any risk. The question is, if my investment is not facing any risk, where I have invested? It means you have invested in government bonds. In that case, logically K should be equal to RF. Even now mathematically you can see that K is equal to RF, which is 8%, plus RM, that is 15 minus 8, but 0. So mathematically you can see that. So when you are making an investment and you are not facing any risk, then logically your investment is risk-free. When your investment is risk-free, then obviously KE will be equal to RF. Second, if equity beta is less than 1, whenever equity beta is less than 1, it means your investment is less riskier than the market. When your investment is less riskier than the market, then your KE will be lower than RM. Actually, RM is the average return on the stock exchange. RM is the average return on the stock exchange. RM is the average return on the stock exchange. So whenever equity beta is less than 1, the interpretation is your investment is less riskier than the market. Then K will be less than RM. Now let's see the mathematically. K is equal to 8%, RM is 15 minus 8, and equity beta is 0.8. So 15 minus 8 gives me 7 into 0.8, 5.6 plus 8, I'm getting 13.6. Okay. Third, equity beta is equal to 1. Equity beta is equal to 1 means it's a benchmark beta, and the interpretation is the investment, your investment systematic risk is actually equal to the market risk. Your investment is facing the same risk which is in the market. If this is the case, then logically KE will be equal to RM. K is equal to 8 plus, yes, K will be equal to RM. 15 minus 8 and then 1. Mathematically, 8 and 8 will be cancelled out, and this will become K is equal to 15%. Fourth and the last is beta equity is more than 1. Equity beta more than 1 means your investment is more riskier than the market. When your investment is more riskier than the market, then logically you will be demanding a return more than the market. If I'm going to demand a return more than the market, then logically KE will be more than RM. Okay. Let's see, K is equal to 8 plus 15 minus 8. Let's see what is the equity beta. What was that? 1.5. 15 minus 8 into 1.5 plus 8. Student, K is 18.5%. Now I want to say one thing which is very important. Okay, now listen this carefully. If your examiner, if the examiner does not give us RF, does not give us RM, only examiner gives us equity beta. By looking at equity beta, we can easily decide either the investment is risk-free, or investment is less riskier than the market, or the investment risk is exactly equal to the market, or the investment risk is more than the market. By looking at equity beta, we can easily decide either the K will be equal to RF, or it will be less than RM, it will be equal to RM, or it will be more than RM. So what I want to say, the KE which comes from CAPM, the KE which comes from capital asset pricing model, it actually relates to systematic risk of your investment. So if somebody is asking a question from you that, okay, the KE which you calculate from CAPM, it actually relates to what? The answer is systematic risk of your investment. Now I want to tell you one more thing, which is very important. It's a first live revision class. The topic is cost of capital. Majority of the students so far, they have seen 3 or 4 lectures. Okay. No one has seen merger and acquisition, of course. It's not a revision class on merger and acquisition. But I want to tell you one concept which is very important and you can understand even though you have not studied merger and acquisition yet. Now, look at this. If my company is APLC and I want to acquire BPLC, fine. Examiner says equity beta of APLC is 1.2. Examiner gives you the information and it says equity beta of A PLC is 1.2 and the examiner says the equity beta of B PLC. Equity beta of B PLC is, let's say, 1.8. Now I want to say one thing. Now, just a minute. Let me use eraser. Okay. APLC wants to acquire BBLC. So A is the acquirer, B is the acquiree. An examiner says the equity beta of APLC is 1.2 and equity beta of BPLC is 1.8. At least by looking the information of equity beta, you can at least write that APLC, acquirer, wants to acquire a company which is actually a more riskier company than APLC. Yes or no, student, tell me. We have not studied merger and acquisition, of course, but at least by looking at equity beta, you can write this. It means APLC wants to acquire a riskier company than APLC because equity beta is 1.8, which is more than APLC. Now, let's little bit more in depth. Let's say examiner has given you or you have calculated beta asset. First of all, beta asset is a measure of business risk. Another interpretation of beta asset is ungeared beta, means it does not have the impact of financial gearing. Beta asset of APLC, I'm just assuming it is 0.8 and beta asset of BPLC is, let's say, 1.2. So now you can add more interpretation. One, obviously equity beta of BPLC is more than APLC. Another thing is the business risk of BPLC is more than APLC. Now listen to me carefully. If APLC directors, they are saying in the question, we want to acquire BPLC to reduce the risk of the business. Come on. You are not going to reduce the risk of the business. Technically, logically, you are going to acquire a business which is actually, you are going to acquire a company which is actually facing the risk even more than what you are facing. So there should be some other reasons of acquiring BPLC rather than saying we just want to acquire BPLC so that we can reduce the business risk. You are not going to reduce the business risk. You will end up by facing even more than what you are facing right now. There should be other reasons. So what I want to just tell you, we have not studied merger and acquisition yet. Just a simple interpretation of equity beta and beta asset, it can help you even in merger and acquisition. Okay. Now let's move ahead. Dividend CAPM is not the only model to calculate KE. There is one more model. By using that, we can calculate KE. That is dividend valuation model, DVM. DGM, dividend valuation model, dividend growth model. Now, I want to tell you let me first write the formula, then I'll tell you one thing. The formula is K is equal to D naught 1 plus G upon P naught and plus G. K, cost of equity. Another interpretation is minimum return required by the equity holder. D naught, current dividend per share. Okay, there's a question. Okay. Now, student, let me explain a little bit more. First of all, you need to understand one thing. What is systematic risk? Systematic risk is not a diversifiable risk. Examples. Increase in interest rate. Increase in interest rate. If your government increases the interest rate, which means that if I'm going to take loan, I need loan right now. Will I be paying lower interest rate or a higher interest rate? Student, tell me quickly. Will I be paying lower interest rate or higher? Waiting for the answer. Obviously, I'll be paying a higher interest rate. So increase in the interest rate, increase in the interest rate. Increase in the interest rate is the example of systematic risk. Okay. Increase in the interest rate is the example of systematic risk. Number one. Number two, now when exactly I'll be paying more interest? Can I say when I'm going to take loan? Yes or no? If I'm not taking the loan, I will not be paying higher interest rate. If I'm not taking loan, then I'll not be paying higher interest rate. Now listen carefully. I want to Explain little bit business risk. Equity beta actually is a measure of two risks. One is financial risk, another is business risk. Equity beta measures financial risk and business risk. Beta asset actually measures only business risk. Now keep listening carefully. Equity beta measures financial risk as well as business risk. When do we face financial risk? When there is debt in the business, when there is a loan in the business. If my company has taken the loan, I have to face financial risk. A very simple interpretation of financial risk is interest payment. When do I need to pay interest? When I have taken the loan. Companies, they will face financial risk if they have raised, they have debt in their financial statements. So you have to face the financial risk. Now let's talk about the business risk. Now, what is the meaning of actually business risk? A very simple interpretation of business risk is fluctuation in operating profit. Can I say either I take the loan, I'm not taking the loan, still operating profit will fluctuate? Yes or no? Tell me, students, please. I'm not taking the loan. Even I take the loan, I'm not taking the loan. Can I say I have to face the business risk? I have to face the business risk. Now I just want to give you an example that will make things more clear. Listen. Your government has increased the interest rate. Okay, I don't need loan for my project. My company has got enough internally generated funds. So as far as financial risk is concerned, I'm not taking loan. So that increase in interest rate is not affecting my financial risk because I'm not taking the loan for this project. But I want to say one thing. The project which I'm going to start and the product which I'm going to produce, that product is going to be so expensive. That product is going to be so expensive that whoever is going to buy that product, normally my customer, they need financing. Can I say? If the product is going to be very expensive and normally my customer, they need financing to buy that product. Can I say, even though I am not taking the loan, I don't need loan for this project. I have got enough internally generated funds, but I'm going to face business risk because of this. Now, it will affect my business risk. So I hope now things should be clear. What is exactly business risk? And what is exactly financial risk? And I said systematic risk is the risk which we cannot diversify. We cannot actually spread. We cannot actually reduce. That is systematic risk, which you have to actually face. Now, I'm not taking a loan. I don't need loan. I'm not facing financial risk, but still I have to face the risk of rise in interest rate. That is systematic risk. Now, that rise in interest rate is affecting my business risk. If I take the loan, then it will also affect the financial risk. So what are the possible factors for the business risk? Can I say devaluation of your exchange rate can impact your business positively? The question is devaluation of my exchange rate. How can it affect my business positively? Actually, when your currency is devalued, it encourages export. Because when the foreign exchange will come and then that foreign exchange will be converted in more local currency, export will increase. So I hope now it is clear to everyone what is exactly business risk and what is exactly financial risk. And when it comes to, if you're asking systematic, so I'll say systematic risk is a risk which I cannot diversify. Examples are rise in interest rate, rise in tax rate, impact of exchange rate, could be negative, could be positive. In fact, Political stability or instability is also one of the examples of systematic risk. Now, here I want to tell you one more thing. Beta asset is a measure of business risk only. Equity beta is a measure of financial and business risk. Now, listen. Always remember one point. Equity beta will always be higher than beta asset. Why? Because equity beta is a 2 risk beta and beta asset is a 1 risk beta. So obviously 2 risk beta must be higher than 1 risk beta. Now, there's one more school of thought. Let me write that also. Some of the students, they think another way. They say, why not? That why not teacher is saying equity beta is more than equal to beta asset. Now, let me tell you one thing. Why I'm not saying this. Try to understand. Whenever you come across a question, if you come across a question where your examiner says equity beta is equal to beta asset, assuming you are solving a question of the past paper, and I'm just assuming, an examiner says equity beta of that company is actually equal to beta asset. Now let me tell you one thing. Even though your examiner is saying equity beta is equal to beta asset, the true interpretation is your beta equity is itself a beta asset. When you say equity beta is equal to beta asset, it means your company does not have financial gearing. Your company does not have loan. Obviously, when company does not have a loan, then you are just facing business risk. You are not facing any financial risk. So when the question says equity beta is equal to beta asset, the interpretation is your equity beta is itself a beta asset. Otherwise, you will see beta asset will always be higher than beta equity will always be higher than beta asset because beta equity is a 2 risk beta and beta asset is a 1 risk beta. Okay, now let's move to dividend valuation model. K is equal to D naught 1 plus G upon P naught plus G. G is the annual dividend growth rate. In DVM, we assume that annual dividend growth rate is constant. P naught is current share price X dividend excluding dividend. Okay. Now listen. K is equal to D naught 1 plus G upon P naught plus G. If I'm using this formula for calculating K, mathematically K will be higher than annual dividend growth rate always. Look at the simple maths. We are adding this growth rate. Whatever the answer comes first. So mathematically K will be higher than annual dividend growth rate if I'm using dividend valuation model. Now, some of the students, they think like that, sir, how do I know? How do I know? Do I need to use DVM or CAPM? Come on, it's very simple. Data, given information will let you know automatically that which formula you need to use it. If your examiner has given you RF, RM, equity beta, obviously you will go for CAPM. If there is no information of CAPM, if MM plus tax equation is also not possible, and D naught, P naught, annual dividend growth rate is given, so obviously I'll go for dividend valuation model to calculate K. One more thing, if for a moment, just assume, assuming that annual dividend growth rate is 0, I'm just assuming, okay, so the K is equal to, logically this will become 0, this will become 0, so K will be equal to D naught upon P naught. Obviously, then you multiply this with 100 to get percentage. So when K will be equal to D naught divided by P naught when growth rate is going to be 0. If it is 0, then this is your formula. Okay. And P naught is current ordinary share price X dividend. X dividend means excluding dividend. And nothing is mentioned. We always assume given ordinary share price is excluding dividend. In case of cum dividend, examiner will specifically mention that given price is cum dividend. Okay. I'm just giving one small question. I want everyone to solve this. Dividend per share 0.42 in 2020. then it is 4.6 in 2021, 4.8, 5.6, okay. Current share price, 13.62 cum div. Cum div means including dividend. I want everyone to calculate KE. Whatever you think that this is the way to calculate KE, I want you to try this. I'm giving you 2 minutes. Then obviously we'll be attempting this together. Don't worry at all. Students, any answer? I'm giving you 3 minutes because Azan is sounding also. So within 3 minutes, we will be solving it together, inshallah. Student, first of all, we need to calculate annual dividend growth rate. How do we calculate? Very simple. Okay. 13% is almost the answer given by one of the students. Annual dividend growth rate is equal to, okay. First of all, we'll take the last dividend, which is 0.62. Then divided by the first dividend in the question, 0.42. Now, how many years are given? 1, 2, 3, 4, 5, and 6. Okay. Power is going to be 1 upon 5 minus 1. But just 2 minutes break. Azan is sounding. Just. Okay, students, 1 upon 5 means actually the power will be 0.2. So 0.62 divided by 0.42. Whatever comes, power is going to be 0. 1 divided by 5 gives you 0.2. Minus 1, then multiply by 100%. So G is coming 8.1%. Or you can even take 8%. Okay. 8.1% or 8, both are acceptable, no issue at all. K is equal to current dividend into growth rate. Current share price is 13.62 cum div. So we have to deduct the dividend to make it X dividend. So let's see 0.62 into 1.08 divided by 13 plus this. So 13.15 or 13% is perfectly all right. Okay. Students, since it is the first live revision class, I mentioned earlier also, it will not be long at all. But from the next class onwards, at least duration is going to be 1.5 hours. Then slowly and gradually it will increase. And what is the agenda for the coming live revision class? The main agenda for the coming live revision class is to discuss all, I'm saying all remaining concepts of cost of capital. All means all, including preposition to as well. So I strongly believe today's class you people have enjoyed. Do give the feedback about today's class in your relevant WhatsApp groups. Is there anything you want to ask? You can ask. I'm just pausing the video before I end the class. It's the last minute of the class. Anything you want to? Okay, there's a question regarding, I would say, practice questions. Now listen please carefully. You just follow the video lectures which are on the portal. Automatically it will lead you to the practice videos. There are tons of practice videos. You don't take any tension about practice videos, about homework. Right now, you just focus on the video lectures which are given to you. Okay? Then automatically, the time will come, at least around 10 tests we are going to conduct, but you will be checking the test by yourself. On each test, you will be getting a proper video lecture. So right now, I would say one thing. Just try to complete the lectures. I hope now it is clear to everyone. There are tons of practice videos. Pre-scene mock, June 25 is already there. Pre-scene mock, September 25 is there. There's so many. I'm not mentioning right now. So don't worry at all. You have plenty of videos regarding when it comes to practice. Anything else if you want to ask, you can always send me the private messages on my WhatsApp. So thank you very much. Hope to see you all and others in the next class.